Okay, welcome back. There's, 45 minutes to go for the pre-open session. SGX Nifty futures are on your screen, indicating about 1/3% cut. Overnight, Nasdaq was the big culprit, down about over 2% or so. Gurmeet Chadha is co-founder and CEO at Complete Circle Consultants. He's joining us to take some questions. Gurmeet, great to have you with us here. Good morning. Thank you very much. Let's just start with, it's almost become a very predictable thing. People buy IT stocks when they know Accenture is reporting later in that day, US time, and expect to see stocks higher. Will we see a repeat today? Numbers from Accenture are pretty strong.
Good morning, Prashant. I think there could be some rub-off, as always happened, as you pointed out. But I think broadly, if you see more from a fundamental basis, I firmly believe most corporates, large, mid, even small, are embarking upon this tech upgrade. It's led by cloud. It's led by cloud and anchored by cloud, and then obviously this growth coming from other digital services, including data analytics, Internet of Things, SaaS, and other platforms. And I think this trend is here to continue. If you see the recent reports, the tech budget as a percentage of revenues has gone up from 3% to 5%, more than 5% for a few large corporates. We interact with a lot of NCR-based promoters, and I think the kind of tech spending we are seeing, I think, is unprecedented. So I think this is a more long-term theme to view. I would not say multi-year, but at least in the medium term, I think the spending would be strong, which will add a few basis points to the overall industry growth. Within that, also, if you see, the market is differentiating. It's not that the all tech stocks have gone up. Even in tier one stocks, there is a visible difference between, let's say, an Infosys or and TCS. Even in mid cap ones, the market is differentiating. So I think probably the next year, which is FY 2022, you should basically be clear on which is doing those industry leading growth, which is upping the guidance both on revenue and margins, and which is handling the supply side constraints pretty well.
Take a point on the tech space, Gurmeet. Yesterday we did see some moves come by on the IT index, which was virtually the only one that ended closer to the higher end of the trading range. But let's talk about the financial stocks. The Nifty Bank has been underperforming in yesterday's trading session, and Bajaj Finance in particular, not a part of the Nifty Bank, but the first three trading sessions of this week, it saw a big dip on account of that brokerage note that came in from CLSA as well. They have a target price of 6,000 rupees on that stock. Yesterday, it found its feet, maybe some bit of profit booking by the shorts if you must. What are your thoughts on this space and Bajaj Finance in particular?
I think pretty constructive on financials, especially, some of the tier one private banks and NBFCs and a couple of housing finance names. Bajaj Finance always has been a high beta stock both ways, Mangalam. If you see, there have been times valuations have always been stressed in the last 5 years. Barring that COVID period, I've never seen Bajaj Finance cheaper. And always the valuations have been on the other side. I think the fact is they've managed to grow the AUM by more than 30% on that base is commendable. They have more than 30 different lines. And I think if I were to and in between there was a comparison that it's more a fintech play, right? And not really the traditional NBFC play. But I still think at maybe around 7,000 levels, it's valuations do look fresh. I think the better options are something like an ICICI Bank, great turnaround happening on asset quality, great digital initiatives. Very, very impressed with the digital analyst meet they did. Look at the capabilities they are adding on retail banking, payment, lending. The asset quality metrics have been in best shape ever. If I can recollect, even some of the tier one PSU bank like an SBI, almost one book value, all subsidiaries doing well, gross NPS down 40%, SBI MF IPO should be up, so there's some unlocking happening there. So I think tier one private banks purely from a risk reward with ICICI, SBI, Axis in that order, I think make the preference list.
Okay, so tier one private banks. Gurmeet, hi, good morning. I have to ask you your thoughts on TVS Motor. There was a big slide yesterday, despite that, announcement with BMW. Do you think it's a bit late in the day for TVS to be, furthering its EV plans, considering that most of its peers are already well entrenched? And how are you positioned on the stock now?
So actually, it's a very, very interesting space. I think two-wheeler space is something where we probably will see the maximum disruption. Also due to the startups, which is Ola Electric, Ether. I think we'll have to wait how this pans out. I agree with you. Probably on the curve, it's slightly delayed. But right now, what is selling is what is available. What eventually will sell in the medium term is what is quality. So bigger brands can't come up with a launch just because EV has to be launched. There is a reputation to guard, which is not the case as much with some of the new startups, right? You are more nimble-footed and you can pivot things. I think the better way to play is to play the entire EV ecosystem, not just confine yourself to who's doing EV tie-ups. I think you should play the EV charging space. You should play the EV entire ecosystem, which companies are, adding, probably will add more kit value per vehicle. That's a better way to play, and also play this entire clean energy space, not just EV. It's biofuel. It could be hydrogen based. The ethanol stories, etc. So I think you have to have a probably comprehensive energy portfolio, and do not have fixed thoughts on whether TVS is better or XYZ is better.
A bunch of more stocks we want to talk with you about, Gurmeet. RateGain is essentially the new kid in the block. Lists today, and grey market is suggestive that maybe it lists at a premium, maybe around under 10%, in that range. Agam is here though to tell us a little bit more about the company, how the subscription numbers look like, and whether there are comparables already out there, and how the valuations stack up. Agam, over to you.
Right, so RateGain Travel is a software as a service company, essentially catering to hospitality and the travel tourism industry. Besides that, it has over 1,460 customers across hotels, airlines, as well as online travel agents. Now, it's issued at a price of around 425 rupees per share. And, Prashant, as you mentioned, it has seen a substantial subscription coming through. In fact, oversubscribed to the tune of nearly 17.4 times on overall basis, where retail participation has been around 8 times, but it's the HNI participation which has been substantial at around 42 times. If you consider the valuations, FY21 was loss-making, which is why we can't consider the price-to-earnings ratio. However, if you consider the price-to-sales ratio, even at the issue price, it stands at around 18 times, which is substantially high. On a 25% discount, it would still be at around 13.6 times, and on a 30% premium to the issue price, it would be a staggering 23.5 times. So it certainly is issued at a substantial premium. And besides that, we'll have to watch out for how things pan out in terms of its debut today.
Gurmeet, Agam, thank you very much for that. Gurmeet, any thoughts on this one? RateGain, have you looked at it?
Yes, Prashant, I have, and I think as I said, this is a different world, needs different lenses. 18, 19 times price to sale is high on the view, and also the fact that the primary segment is travel and hotels and the entire, if I were to say the reopening trade, which we broadly club it, we are not sure on this new variant also how much impact it will have in terms of, restrained economic activity. Already seeing cases go up. So would be a little careful there. And as I said, make a concept bucket. I think there are enough ideas of these new age companies. Some of them will really become big. I'm more keen on something like an ad tech, some prominent players in fintech, some of the direct to consumer names which are more broad based and not really affected by these COVID-led disruptions.
Take your point, Gurmeet. Just hang in there for a moment, because you might want to listen into this conversation that we're having.